Hello, everyone, and welcome to today's Blockworks webinar, the Market Structure Special, Flows with Liquidity and Arbitrage. Today's episode is made possible by LMAX Digital. I'd like to invite our speakers to unmute their lines and turn on video. During the webinar, please submit your questions to our speakers through the Q&A button at the bottom of your screen. We'll save some time at the end of the discussion to answer these. The session will be available on demand, and all registrants will receive an email once the recording is live. I'd now like to turn the event over to Blockworks co-founder, Mike Ippolito. Mike, please go ahead.
Awesome. Thank you very much, Jane. Appreciate it. There's nothing like the clash to get everyone in the mood to talk about market structure and and digital assets. Very excited today to be joined by David Mercer, CEO of LMAX Group, and Michael Sonnenshein, CEO over at Grayscale. I do want to give a quick shout out to David and the folks at LMAX Digital for making this possible. A couple of words about LMAX Digital. So they are the institutional cryptocurrency exchange that is a part of the broader LMAX Group, and they're operating a leading FCA regulated trading venue. So what's really interesting about what LMAX has done is they basically leverage the group's proven robust technology and liquidity relationships to create a really great market leading solution for physical trading and custodial services. They deliver deep trust, reliability, and institutional liquidity. And as a personal aside, we've gotten to work with them for a long period of time. They've really led the way in a lot of these institutional talks. They've been a great partner, and I'm really excited to get into the conversation here. And we'll get more information kind of later in the session. And with that intro, David, I'm going to pick on you to go first here and just do a quick intro before we get into it.
Good afternoon, everyone. And London is indeed calling. So London is border of LMAX, which actually initially stood for London Multi-Asset Exchange. So look, we're an exchange operator. We run 5 exchanges globally, primarily in the FX market. So we have 4 FX exchanges in London, New York, Tokyo. The 5th exchange we launched 3 years ago, hopefully prescient. We launched LMAX Digital at the request really of our institutional partners who trade with us in foreign exchange. Who said, look, David, we'd like an industrial scale, robust technology solution where we can exchange risk with like-minded participants. So we put it up 2018, right into the crypto winter, as I said, and luckily enough, 2021 has been a good year. Traditionally, we trade about $30 billion a day in foreign exchange. The ADV this year in crypto has been about 3 billion. Best day was 6.6 billion back in that crazy Wednesday in the middle of May. We traded $75 billion of crypto assets in May. I'm happy to be here today and happy to discuss the future of the crypto ecosystem.
Awesome. Thank you, David. Mike, I'll pick on you to go next.
Yeah, great to be here. Thank you so much for having me. So I'm Michael Sonnenshein. I'm CEO of Grayscale Investments. We are the world's largest digital currency asset management business. So we date back to late 2013. Some of you may know us, already be involved with some of our products. Flagship fund is Grayscale Bitcoin Trust, trades under the symbol GBTC. Today we manage call it about $36 billion spread across a family of 14 different investment products. And so I think for us, really our role in the ecosystem is one that really is all about providing access. We were lucky and fortunate to be early to identify this asset class, realize it was going to have some frictions associated with investors being able to get involved with it, where to buy crypto, how to hold it, transfer it, safekeep it. And so to address those challenges head on, we have continued to build out the Grayscale product family, and super excited to be here today and excited to share some of the insights we're getting from our clients as well.
Awesome. Thanks, everyone. So let's just dive right into it here. Really what I'd like to focus on a large part of this talk is just market structure in general. And as we all know, one of the big shifts in crypto over the course of the last, say, 12 months is that it is kind of slowly transitioning from this very retail grassroots driven asset into a more institutional sort of background. And that has a lot of implications, both for the assets that are getting created, but also for the market structure around those assets. So I'd actually love to start with just kind of getting your sense on a pulse for institutional demand at the current time, right? As we were kind of looking at massive inflows right across Bitcoin, but also other major products like ETH over the course of the last, let's say, September all the way leading up through February, it looks as though there was a period of time where it kind of pittered out a little bit, but now things look like they might be picking back up for Bitcoin, but also some other crypto related products as well. You guys are so much more on the ground than I am. Can you just give me a sense of like, what does the kind of pulse of institutional demand feel like at this particular moment in time? And how do you see that playing out over the course of the next, say, 12 months?
If you like, I'll give you the exchange perspective, and Michael.
Perfect.
Perspective from an investment standpoint. Look, without saying too much about LMAX Digital, I would say that we have to be a barometer for institutional interest. Put simply, we wouldn't exist if there was no institutional interest in crypto assets. So we don't do retail. There's only one exchange traded more than me in Bitcoin last month. You may have heard of them. They did a very public listing recently. They have 50-something million customers. We have 500. So, you know, we wouldn't have traded that 75 billion in May if there was no institutional interest. But what's key, without just being an advertorial here, and Michael mentioned it in his intro, which I thought was excellent, talked about market access. That is the key to any capital market. Most of what we do is just providing market access. And I say we advisedly, whether you be a fund manager, an asset manager, a bank, an exchange, a broker, you just provide market access. And one of the things we like to do at LMAX Group is, I always say, never leave a ticket unprinted. So the bedrock of every marketplace is the institutional exchange framework, right? That bedrock, that foundation, and then those prices, right? And that service can hit every segment in the market. So there's no doubt that the market has been retail dominated. But if you look at any traditional asset class, I know a bit about foreign exchange, so let me tell you this. Exchange trades $7 trillion a day. Only 20% of that is retail. I think you'd be looking at the traded volumes in crypto and say it's the other way around. It's been the other way around for the last decade. But that's okay. That's the evangelists, that's the scientists that really got it when it was hard to access the product. And slowly you're going to see this transition to institutions. And at the same time, when you see that development to institution, you'll end up providing a better service, a better product, and provide better market access to all segments of the marketplace, be they private investors, be they banks, hedge funds, or asset managers. So we're not done as in terms of as a capital market today. It's not perfect. Access is still quite difficult. Hence why you saw things like the GBTC launched to great success, because it was hard for people to access the marketplace, and it is at times still difficult. And I say people advisedly. That can mean a bank as well as Mr. and Mrs. Smith. So we're making steps in that direction. But I call it the ABC of crypto: adoption, banking, and credit. These are the key things that we need to address to widen that market access. And that's my position from an exchange perspective. I'm seeing more and more institutions every day, and it'd be interesting to hear what Michael thinks from an investor standpoint.
Yeah, I mean, I think it's I think one of the best ways to kind of directly answer your question, Michael, is to kind of talk about why the dynamics within this market are different in 2020 and 2021 than perhaps they were when we went through our last real material bull market in 2017. And so when we kind of zoom out and look at the broader picture, crypto has been one of those very, nuanced asset classes, which, I think we all agree new asset classes are not born every day. And it's been interesting to see that, this is one of the first times where a new asset class came along and retail actually had access before it to the asset class than did institutions, right? Typically, you kind of see the reverse of that. You see institutional investors typically have access to kind of, through their banks or, the prime brokers or whoever they're, typically doing their investments with. And then those types of investments or opportunities kind of trickle their way down to retail. And while certainly the 2017 bull market was definitely much more retail driven, what we've now seen since that time throughout 2018, 2019, last year, and now into this year is real institutional adoption. And I think a couple of things have really changed in the market that has allowed for institutional participation that maybe wasn't there before. So I think number one, we have a much healthier market overall. And I think a healthier market is a multifaceted concept. It's a market that's much more two-sided. It's a market that has weeded out a lot of bad apples or a lot of participants that maybe were not operating with as buttoned up or as compliant an operating model as we would have liked to see around this. I think we've seen the true development of derivatives, of borrowing and lending. I mean, these are the types of tools that, you know, institutional investors are typically used to seeing surrounding the investments that they're making. And so the ability to have a bona fide hedge, the ability to lend, the ability to get credit, you know, these types of dynamics weren't really ever at play in crypto until, you know, only the last, you know, couple of years. And so what that's allowed for is the entrance really for a lot of institutions who I think now realize that there's really no stigma, career risk, whatever you want to call it, associated with their participation in the ecosystem. So I think that's been shrugged off or maybe been graduated from. And you also have this tremendous air cover that's been provided to institutions in order to participate in the ecosystem because they're seeing some very, very famous, very well followed investors or even now corporates beginning to participate in this ecosystem that lends itself to a certain level of validity or somewhat of the staying power of the asset class. And I think what actually has even stepped on the gas even harder is really the macro environment for a lot of institutions. You know, they look at the economic stimulus that's being injected into economies here in the US economy, economies overseas as well, certainly in the wake of the pandemic. And so there's this new found, you know, almost kind of newfound interest or new kind of intense focus from institutions on the ideas of stores of value and what constitutes an inflation hedge and, you know, really rethinking a lot of these preconceived notions. And so when you kind of sum up all of those factors, I mean, certainly from my purview, I don't think we could think of a better, you know, scenario for crypto. We couldn't think of an environment where crypto could thrive better. You know, there's been a sufficient amount of regulatory clarity provided. So institutional adoption has been tremendous. And I just finally say that, you know, the last thing around institutions is not just these elements that I outlined, but also actually now that, you know, and this is something I'm sure is key for David and his business as well, is that there's a shared appreciation that crypto is in fact an asset class. Institutions had historically, you know, kind of initially made their first foray here, only talking about or only allocating to Bitcoin. But there is a very, very well held and kind of shared appreciation that there's an entire ecosystem of protocols that are worthy of investing in, worthy of investigating. And so there's been a very large trend of diversification within crypto exposure for institutions as well.
Yeah, absolutely. So there's kind of, I mean, there's a lot of great info there. Like, I guess one of my takeaways is that there are kind of two drivers here, like summarizing everything that you guys just said. There's a very kind of market structure look, the actual tools that institutional investors have, right? A lot of like the just operational roadblocks from investing in this asset class have been removed, and therefore you're starting to see a lot more activity. On the other hand, like deep fundamental kind of macro drivers are also encouraging investors to trade in this asset class, look at this asset class, to invest in it. Maybe let's start with the former, talk a little bit more about the infrastructure. David, you were starting to kind of get into this when you started to talk about the ABCs, the adoption, banking, credit of crypto. So talk a little bit about like, what are institutions used to, how are they used to interacting with market? How are they used to getting that market access? And what are some of the recent developments that have encouraged them to become more active in this space?
Yeah, look, I think it's the way the analogy is just, there's a lot of plumbing in capital markets, right? And the plumbing either is non-existent in crypto or it's blocked. So put simply, I mean, Michael's right. There's no doubt you've seen the comments this week from two well-known hedge fund managers, for example. And I think that, you know, it's clear that they like to access the market. Now, how would they normally do that? So you look at my business in foreign exchange. I'm just a simple exchange operator. We match buyers and sellers. No one is looking to face me credit-wise on the FX exchange business. How is that facilitated? Well, in foreign exchange, you have these great things called prime brokers. They tend to be the world's leading banks. So they're extending credit to their funds, their asset managers, their corporate clients. They're all happy with each other's balance sheet. They extend credit and they effectively execute on an exchange on their behalf. Futures exchanges. You have central clearinghouses. So today, that doesn't quite exist. So we're going to need that B in the ABC, banking, and C, credit, to come into the market. So that, the best quote, probably the best way I can analyze this is, a very large client of mine 3 weeks ago said, David, don't talk to me about blockchain. Don't talk to me about wallets. Don't talk to me about security and keys. I don't care. I want to trade it the way I trade Eurodollar. So we're going to need better credit intermediation for that. You have some brave corporates out there, well-known car company comes in and, buys his crypto himself. Other well-known fund goes and buys it himself. Of course, it's possible. Of course, that happens with me. But there's a lot of them that just want to follow their existing plumbing, their existing credit network. They don't want to open up another credit relationship. And you sort of think, well, will these banks come into the base? Will these credit intermediaries come into? They're going to have to. Because what happens if you go down Wall Street right now, ask any banker, any private banker, and they'll tell you that their customers are taking money out of their accounts to trade on a crypto exchange or to buy a crypto asset. Very simply, they'll want to provide that service to those clients. They own those clients today. If they don't service those clients, they might lose them forever. And they don't want to do that because those relationships are valuable to them in equities, in fixed income, in foreign exchange, in futures, in pensions, in wealth management products, all the way down to mortgages. So they've just got to provide the service. It's definitely coming. I mean, the best example I can give you again is when I knocked on 34 banks' doors, that's how many banks trade with us in our FX exchanges, in 2017, they all said, not now, David. But this year alone, I have 11 of the 34 taking market data from me today. 11. 3 fully onboarded, ready to trade. Now, they're not taking massive prop positions internally. That's not what they're going to be doing it for. They just want to facilitate their client trading. And the client doesn't necessarily have to open an account with me or XYZ exchange. They can just access it through that credit intermediation. I think that's going to be the biggest unblocker. And with that comes swathes of money. I mean, swathes of money. There's $110 trillion of assets under management today, right now today, that has to be invested. A lot of it comes from pension funds and wealth managers. Has to be invested. Now, if only 5% of that went into crypto market cap would have to go up 5x to facilitate that 5%. So it's definitely coming. And you'll see the whole crypto market completely transition from what it is today and what it was in 2017 to what you will see in 2025. And you're going to see a much bigger, more robust institutional framework. Again, back to the earlier point, will provide market access to all.
Yeah. And by the way, lest anyone think that that's a bold number, 5%, there was a survey of hedge funds that came out in the Financial Times. I think that was published earlier this week, maybe Tuesday, and basically had like 96% we're talking about allocating 7.5% hedge funds. So that was I read that and I was like, oh my God, wow, that's pretty very cool. Also, that is a great overview of kind of the infrastructure part of it. Maybe Michael, you could speak a little bit to some of those more kind of macro drivers. Obviously, we just watched the FOMC yesterday. There's kind of talk of, people are always trying to read the tea leaves, right? And they're looking at dot plots and everything, but there's kind of talk of tapering. Inflation is starting to pick up, right? The expectations have been revised up from 2.4% to 3.4%. I think you're absolutely right. The narrative of like global debasement of currencies really took hold, certainly in March of last year. Talk to us a little bit about like, how are investors kind of thinking about this standpoint? Are they really excited about that devaluation, inflation, or I guess like financial oppression hedge in Bitcoin? And how are they kind of thinking once maybe they have locked onto that narrative, how they're expanding into other types of different crypto assets?
Yeah, there's a lot there. So I'd say for starters, let's start with kind of Bitcoin for one. There's a very, well-held narrative now, about Bitcoin being digital gold, the digital store of value. And so investors now have 10, 12 years of history of seeing how Bitcoin reacts when there are, macroeconomic shocks. And so we've seen, Bitcoin, outperform when we've seen Brexit, devaluation of the renminbi, all different types of shocks. And so I think, thinking about it as a flight to safety for certain investors or even an inflation hedge has come up and solidified in a lot of investors' minds such that they're now, actually tailoring back parts of their allocation to gold and other assets that they've historically used in their portfolios to serve as that function and reallocated it into Bitcoin. We look back at the end of Q4 of last year and we saw some of the largest outflows on record from gold funds as Bitcoin was kind of taking off to kind of new all-time highs, and don't think that's the least bit, coincidental. That's probably also only being made even more of a magnified move because there's also this kind of generational wealth shift underway from older generations to younger generations, about $68 trillion over the next 25 years. And so, you see this rotation away from, assets that maybe younger generations don't necessarily have direct, firsthand experiences with, like gold, but maybe, this is a generation that's growing up in the era of Bitcoin, whatever, may be. I think that, certainly what's now happened, and because of the staying power that Bitcoin has shown, when we look back to the beginning of the pandemic, when Bitcoin nor really any asset could kind of save itself from this massive deleveraging and this massive downturn in the market, many investors, I think, were really impressed by how resilient Bitcoin was and how quickly it snapped back, and then obviously went on to kind of reach all-time highs and become the best performing asset and asset class over the course of last year. And so that has woken a lot of investors up to the idea that there have to be other opportunities within crypto as well. A lot of these other assets are, forming partnerships, are getting development, are starting to develop real world use cases that are coming to fruition. And so we've started to see investors begin to think about, privacy, gaming, the democratization of how content is being consumed and monetized. And, these are some of the kind of intersections between some of the digital currency protocols, which, like Bitcoin, are native, born on the internet, looking to disrupt, displace, create efficiencies, et cetera, in some of these other more legacy systems that have either failed us or are kind of ripe to be leapfrogged, whatever the case may be. And so we've certainly seen kind of the emergence of now, probably the first time was probably sometime during 2020, an Ethereum only or an Ethereum first investor, which was really interesting because, again, we'd always seen investors typically allocate first to Bitcoin. And I think a lot of that's been driven by the emergence of smart contracts and DeFi and all the layers that have been built on top of the Ethereum ecosystem. But now, again, also moving into other protocols as well, as they too are starting to get traction. So I think while this group and David and I could probably talk ad nauseum about the things that we're seeing and experiencing, and I'm sure those listening and following along with this are seeing, Bitcoin on CNBC every 5 seconds, and all the kind of news and cycles around this asset class. I can't stress enough, it is still so early, and I just want to hammer home something that David said about plumbing, which is really an analogy that we talk about with our clients as well, because you have this entire ecosystem of tools that are being developed in crypto, order management systems, fantastic, exchanges, things like LMAX, tax lot reporting, APIs, all these things being developed over here. And not only is there no plumbing that connects it to the legacy financial system, the pipes aren't even pointing in the same direction at the moment, right? And so we are excited to see some of that connectivity happen, not only because we think that it will draw in a lot more capital into the asset class, but actually because it will draw in the incremental user and adopter of this ecosystem and of this asset class. So the amount of people that will be investing in this and making crypto accessibility as straightforward as it is to access stocks and bonds, and the ways that investors are typically accessing investment opportunities is going to be a really, really, really big catalyst. And so succinctly said, it's still early, despite kind of the fever that we all probably see and feel every day.
Yeah, it's like the biggest, like if you look at capital markets, the function of what they're supposed to do, they're supposed to allocate capital to the projects that need it most, right? Or most deserving, as is judged by the market. If you look at crypto is the growth of a new asset class, which, as you said, doesn't happen every day. There are technical challenges to allocating to that new asset class. And I think if you look at basically every big business in this space that has been built, it's a market access business, right? It is a conduit that allows capital to flow or allocate to crypto. Both of your guys' businesses, LMAX and Grayscale, are phenomenal examples of this, right? David, you're allowing institutional capital to allocate and trade with the space. Michael, you're allowing big investors to gain access to the space through your structured products. Like every big business has been built like this essentially. And there's still, to your point, so much more room to go. Like it's crazy how early we really are. So I think, for Bitcoin, I guess there are, even though there's still so much more room to go, like if you think about it, David, you kind of made this point where, look, don't tell me about keys and, public key cryptography. I just want to be able to trade this stuff, right? Like how I trade everything else. And there are steps for like the big crypto assets. Like you've got CME Group based out of the US. Anyone who's a CTA, right, it can trade essentially Bitcoin futures, right? And then there's going to be Ethereum futures soon as well. Michael, to your point about this whole wide world of different assets that are starting to get built and developed, that ability doesn't yet exist for them, right? So probably even as rudimentary as the plumbing is for Bitcoin and ETH, maybe it really doesn't exist for this other class of assets. So how do we start building out infrastructure that's going to support not just Bitcoin, right, but this like longer tail of different crypto assets? Like how are we going to move out along the curve essentially and create the infrastructure to support them?
Yeah, I mean, I wish I had the answers, and if I did, I'd be building it. But I think, one of the things that we're doing, certainly at Grayscale is trying to, as best we can, to always stay ahead of that kind of rising investor demand, right? So when we have identified protocols that we think are intriguing and kind of pass through all the different things that we look at before we launch a product and kind of reconcile that with where investors may be telling us they're interested in deploying capital, because that infrastructure is not there, we will go ahead and launch an investment product so that investors can access some of these, I don't want to call them off the run, but perhaps, undiscovered or less loved or less recognized assets. And so again, there was a time when a lot of people kind of left Ethereum for dead and thought that Bitcoin would be the only digital currency that would ever exist, right? And now we've seen, this entire ecosystem that's been built on top of Ethereum, the launch of now Ethereum futures, regulated environment around Ethereum. And so, I guess it stands to reason that over time, perhaps some of these other protocols that are gaining adoption, gaining traction, they too will be able to have that same level of development, derivatives, and institutional tools built around them that will fold them into a similar path. I guess where I and folks like David as well, I'm sure can sometimes get frustrated is when folks kind of don't zoom out and look at how much has happened in just the last 10 or 12 years that this asset class has been around. We have to be patient and kind of let some of these assets either rise to success and continue to gain adoption and be folded into some of those frameworks, or many of them will also peter out because the barrier to entry is not terribly high to create and launch new assets.
I mean, what I'd say, so absolutely right. Number one message there, I think, is let it breathe. These are all scientific experiments, science experiments. Let it breathe. Like I said, let it ride. But actually, we can all help. Right, we can bridge the gap. I think that's why we're slightly unusual. People look at LMAX Group and go, aren't you the old status quo? Aren't we, the evangelists? Aren't we trying to fight you? Aren't we trying to change you? No, I straddle the two, right? So yes, I'm in foreign exchange, the world's largest capital market, $7 trillion a day. But hey, I'm also in the digital space. So how can we bridge the gap? So you mentioned some other exchange. I won't give them mention. I don't think they add to the ecosystem because they trade 5 days a week. What's the point in having a crypto future that trades 5 days, right? You want to add to the crypto ecosystem, you're going to be 7 days a week, 24 hours a day, 365 days a year, number one. Number two, you did right. So look, I have my phone here. I have MetaMask on it. Do I know what I'm doing in DeFi? Not really. I'm learning like everyone else. I have a bunch of clever guys behind me in the technology department, who can understand, right, cryptography, right? And they go and research blockchains. And we have, it wouldn't surprise you, we have a new pitch every week. But how can we help simply? Well, we're an on-ramp. We're a fiat on-ramp because of the nature of my FX business, because I've got 160 bank accounts, because we have nostros in 20 different currencies. I'm a fiat on-ramp to crypto. I don't say you don't have to, I just match buyers and sellers again. So you want to buy your Bitcoin, you want to buy your Ethereum. Why are you buying Ethereum? You want to move into DeFi. So then we thought, I'm a centralized exchange. These guys are telling me the whole world is going to be decentralized. How can I help? Well, look at Nirvana. Read Satoshi's white paper, right? Instantaneous settlement. Wouldn't that be amazing? It doesn't exist, guys. It doesn't exist today. Hence why credit is the blocker. But with smart contracts, it can exist. Can we play a part? 100%. My personal view is that every product will be traded against every product 10 years from now. So you'll trade the S&P versus Ethereum or XYZ coin, for sure, 7 days a week. You'll trade gold, S&P, Bitcoin, S&P, Bitcoin, Euro, right? Bitcoin, GBTC or Ethereum, GBTC. That's just the way you're going to do it. Now, then we move into this digitized economy and digital assets and that idea of a smart contract and instantaneous settlement. Well, you need to be able to value it. So we're actively helping the oracles, if you like now, within DeFi to value the assets. I happen to think we have the best foreign exchange market data on the street. I happen to think we have the best crypto market data on the street. So that helps you to value the assets that have that leg in it, right, within DeFi. And if you go the whole way about DeFi, how do I see capital markets evolving? Imagine all of us individually and institutionally, posting our balance sheets on the blockchain, putting our assets to work, which is actually what's happening. Everyone's going, oh, staking, yield farming, and DeFi. Hold on a minute. It's just making your assets work for you. Because at the moment, it's clunky in fiat. It's a bit clunky in traditional capital markets. And I think all of us, Grayscale, LMAX, maybe some other exchanges out there, I don't know, I've never heard of any, can help build that and help value that marketplace. But I think also, capital markets, I love capital markets. I've done it man and boy. I think it's essential. It's also quite fun, right? And we do actually make the world economies rock. So I think they're going to transition more along the lines of DeFi. It's not going to be all to all. It's not going to be peer to peer necessarily. You're still going to have, bigger institutions and getting back down to that credit part. But I really think we can bridge the gap. And also don't criticize the ones. I see a bunch of the crypto advisors out there like fighting with each other about who's got the best blockchain, who's got the fastest one, right? Proof of stake, proof of work. Okay, look, the best ones will win, right? But we must allow those experiments to happen, to develop. And the good news about this modern democratized capital market is that everyone can have input, right? It's not the old school tie, right? It's not a closed shop. So really, I think all of us can help with that growth. And some of it's just education and making it easy. As I say, at the moment, I've got to tell you, for an old guy like me, DeFi is a bit tough to get involved in, right? I had to go and buy my Ether, had to swap it. I don't really understand the coins that well. And I just think it needs to be easier for all. All of us now understand equity trading, for example. When I started out, it was quite hard. I had to call a broker up and he charged me a fortune. And I didn't know what happened to it. And I had share certificates and all types of funny things. But now it's pretty easy. You know, you can open an account like that, click a button and trade, and it probably doesn't cost you anything. So that's what we need to do in the next decade in crypto. Effectively, the same thing that I've seen happen in margin trading and margin FX trading over the last decade.
Well, you know, it's not just the older participants in this. So I'll hazard a guess, David and Sam, a couple years younger than you are. This stuff is confusing for everyone. This stuff is confusing it's not intuitive for anyone. I'm sorry. So there's a lot of hurdles that people have to overcome. There are psychological hurdles that you got to overcome. There are operational hurdles. You know, but I think at the end of the day, too, that's why there's opportunity, right? And we're using this analogy here to describe what's happening in crypto, which is the creation of a new asset class. When you guys look back in history, right, there were some pretty big macro events that actually led to, if not the growth of a new asset class, certainly like a big sea change in it, right? So there were kind of episodes of gold, right? When gold became legal in the US to own, right, back in the 70s, there was a huge bull run, and suddenly gold became an institutional asset class that people wanted to own. There was kind of the breaking of the exchange rate mechanisms where currencies were allowed to free float, and FX went from being kind of a tiny, unimportant market to the largest, most liquid market in the world, right? There are these big like macro events that cause these sea changes, right? And I think that's what we might be seeing in digital assets. And what I guess I would ask from the two of you is like, what are some of the lessons that we can learn, right? Looking back in history at the rise of these asset classes, how can we best take advantage of kind of what's going on? And maybe that's just lessons from the last couple of years riding through this crazy industry, but I'd pose that question to you guys. What can we learn kind of from history to take best advantage of this?
Yeah, I mean, again, coming out swinging with the heavy questions there.
I know
listen,
you can
I think, you know, on the heels of David's commentary, I think so much of this is rooted in education. You know, not only do I think the assets themselves present complexities that make them quite disparate from other investment opportunities that folks are typically used to evaluating, which is why we and others spend quite a considerable amount of our time, you know, writing papers, explainer videos, webinars, roundtables, et cetera. But not even just the assets themselves need help, you know, educating folks around them. There's also the question around valuation. Right. I think a lot of folks don't necessarily know how to value many of these assets, given they're not necessarily cash flowing instruments. They don't necessarily pay dividends. They have complexities around them, be them forks or airdrops or, you know, various elements that you may not necessarily see with a stock or a bond or, you know, some of your more traditional investments. So I think some of the lessons that we can hopefully instill and hopefully create around the asset class is to do so in a way that is super compliant and that allows us to work through the appropriate regulatory channels. We're of the belief that, you know, again, this asset class is evolving faster and more furiously than regulators can probably keep up with, which poses a challenge for them. But I think we've also, at least here in the US, been seeing that we're not necessarily going to see an entire new wave of regulation here and now around these assets specifically. And so as we're kind of democratizing, you know, capital formation and, you know, what constitutes a store of value and the concept of, you know, decentralized non-sovereign, you know, currency, we need to make sure that we're doing so within the existing regulatory framework. And over time, you will see more of that, you know, shape up. What we don't want to do is get, you know, too far out over our skis and really push the boundaries of things such that we're either scaring off regulators from kind of embracing the innovation that's taking place here, or letting things get out of control with, you know, too much leverage or, you know, kind of other bubbles that we've seen, whether it was mortgage-backed securities or, you know, other areas that we can historically look at and see kind of how those ended up when the right guardrails and the right kind of precautions weren't kind of being implemented into them.
Yeah, so actually I might flip it around and say, actually, what can traditional capital markets learn? And actually, literally, I think that's key, right? But I'll try and answer initially the question, what I'd say to everyone entering the space, be they an investor, trader, a fund, a new platform, there's no shortcuts. Don't take the shortcuts. You've seen the repercussions, okay? For example, people talk about regulation. Really, the key is AML, right? There's FATF guidelines that everyone must follow. Every country in the world, bar one, is signed up to them. Follow it. Follow it, that's it, right? It's there for a reason. Whether you're an accountant, you open a new account with your accountant, your lawyer, your bank, or your broker. Follow it. Roughly 9 bits of paper, 9 proofs, source of funds, source of wealth. Just do it. And actually in crypto, it's easier and it can go back further than you can do with the euro and the dollar. So don't take shortcuts there. Ultimately, that can be very painful if you take shortcuts. So please don't. I think the other thing they really could learn, and it goes back to something, sorry if I'm going on about this a bit too much, but credit works quite well in capital markets. Now, don't get me wrong, it didn't always when I was a student and my bank card got stopped at 3 a.m. on a Saturday night, but it does, right? It is the the lubricant that makes the wheels of capital markets spin. It works well until we get to that nirvana perfection of instantaneous settlement, right? You're going to need some credit intermediation. So within crypto, we could learn from that. I know the dream is trustless, anonymous, decentralized. Let's be pragmatic, right? Let's utilize some of that credit intermediation, some of those payment rails. But flipping it around, wow, right? Us old capital markets guys, let's learn from crypto. It's a bit like, when .com, I'm old enough, .com was coming around. You didn't know what was going to win. In fact, I backed all the wrong ones, but there was 100 ones. But we learned a lot now. It's just part of our everyday life. People say to me, oh, David, you're a fintech business. I'm like, show me a finance business that isn't tech now, right? Yeah. Simply, you can't be in finance, you can't be in capital markets unless you're in tech. So we learned from all those things. What can we learn from crypto? Well, guess what? People want 24/7 access. People want regular access to their money. People want to take control, right? People want their own control. They don't want to be told what to do. The world is becoming more used to frictionless, borderless trade. So in some ways, some of the ways you access capital markets today is a bit archaic. Here's just a simple fact for you guys. If I want to give my niece or nephew $100 Aussie dollars as a birthday present, the quickest way for me to get it there is to go to the Bureau de Change, go to Heathrow, buy a plane ticket, fly to Sydney, right? It takes 2 days to get there otherwise, right? Come on, it's archaic. Likewise, I should be able to earn interest every second, every minute, every hour, right? Certainly shouldn't be earning zero, which we currently do in the bank, but it'd be nice.
Negative.
Huh?
Negative,
exactly
or negative
right.
in real wage.
Exactly, in euros. It'd be quite nice if I could just deposit it for 8 hours at a time. So I think there's a lot that traditional capital markets can learn. And I think, by the way, they are. It's not like everyone's ignoring it. Everyone is well aware, certainly in payments, settlement, and reconciliation, there's a lot of good projects going on utilizing blockchain technology. And that is some ways the bedrock of capital markets. All the scare stories you saw about people going out of business, the big banks that have gone out of business historically, it all comes down to cash flow. And settlement, payment, reconciliation. I think blockchain can help that. So there's a lot that both parties can learn. But I think the future, most importantly, I look at it as there's currently a partition, fiat, crypto. And sometimes people are saying, oh, that's bad and this is good. I see a future, and it's not very far away, where that partition wall is knocked down between the two and they coexist. In fact, we will launch an exchange in Asia this year. It'll be the first one of my then 6 exchanges that will have cash crypto, cash foreign exchange on the same platform. So I think that's the stepping stone, and both markets can develop and help each other.
Awesome. Thanks, guys. So that actually kind of wraps up the interview portion here. We've got a lot of audience questions, and I want to make sure that we can get to some of them. But thank you so much for that. That was really interesting. So the first question here, I'm going to paraphrase a little bit here, but there's a question about, so both of you guys kind of brought up existing regulations and how some of crypto has to kind of fold into and not go up too hard against those regulations. When you look at something like the growth of DeFi, right, and you compare that to, like, let's say the experience of sending money around via DeFi or stablecoins or something like that, via interacting throughout the traditional banking system. I will just speak for, I'm co-founder of a company. I usually deal with our banking. It is a freaking nightmare. It's like literally 1 out of 2 payments get stopped. If it's a new vendor, I can't send it. I got to get on the phone with the risk guy. It's an absolute nightmare. And like moving into stablecoins, it happens instantly. I can send wherever I want. It is so much better. It's to the point where I would liken it to, like, when I have to send a wire now, it's like, oh my God, I have to use dial-up internet. It's like crazy. So I guess my question to you guys is, how much should we, because I get that there are really good reasons why that exists, right? I understand all those regulations, but I'm curious, like, what is the push and pull in between? Maybe crypto is forcing us to look at some regulations and say, hey, do we really need this stuff? Like, how do we balance that perspective, like kind of the move fast and break things, with, hey, these regulations are here for a good reason and they keep us all safe? Like, how do you guys personally think about that line?
I mean, zooming out of DeFi specifically, and just looking at the asset class overall, I think, looking at businesses like LMAX and Grayscale, these are really good examples of businesses that are operating in a regulated, compliant way within existing regulatory frameworks. And so as a investor, as a viewer, you should take away that, investors are not waiting for some, entirely new regime of regulations to come in to access this market. In fact, I'd even say here in the US, we don't have an ETF, and investors aren't waiting to access Bitcoin because there is no ETF. They use GBTC, they trade on, all different kinds of exchanges, whatever you have. So I think, when you look at how long the time frame is for new regulation to be passed, whether it is securities-based regulation or investor protection-based rules, these take a long time. They're generally open for public comment. So I think that the truth is that some things that this ecosystem will give rise to will unfortunately foot fault and will unfortunately go too far, and those things will need to be clawed back. I'm sure there are some elements of that within all different factions of the ecosystem. It could be within DeFi, it could be within stable coins, it could be, within privacy focused coins, it could be in any one of these areas. So again, that's kind of why I stress the importance of, really looking to some of the signals we're getting from regulators and some of the goalposts they're kind of putting in the ground to help kind of establish where their comfort level may start and stop.
I mean, I slightly different slant on that, and I'm going to come back to AML again, Michael. You're saying it's frustrating. Okay, it's there for a reason, and there is a push and pull, right? We all assume we're good guys, right? Good people. We all assume we don't want to support criminal activity. But you know what? There's some bad actors out there. Most of the AML rules that you're seeing as clunky, the wire type story, it's just about knowing your customer and carrying out adequate AML checks. Believe it or not, I know they are cumbersome, but once you're done, you're done. And what have you got to hide? Now, I do hear the evangelists say, David, it's my money, I want to trade anonymously. I think there is some experiments going on, some blockchain ones, which I think could help that, right? In that you might get to a new form of KYC and identity checks. A bit like, you'd be amazed how many people have your data right now, but it might be you're prepared to put your data somewhere, and then on request it's released. And that might mean everyone that's in that ecosystem is allowed to trade there. It doesn't mean you have to know that Michael's trading with David, right? Or you might have to know that I'm in Indonesia or Thailand or the United States or the United Kingdom. So look, it is, I can't say anything other than it is a bit painful, but it's there for a reason, right? And that's key. I think it will improve. And if everyone really is legitimate, then what have you got to fear? So that is the biggest, that's the biggest blocker at the moment, and the sort of the push and pull. That's why you're seeing it as being more difficult to use fiat than, say, a stable coin. On the regulation front, funny enough, I like simplicity. I think the regulation exists, right? The framework is there, right? The framework is there for a bank, for a broker, for an exchange, for a fund, for an asset manager. They just need to decide what they're going to do with the instrument, right? Define it as a financial instrument, which bucket it falls into, then you have regulation. And I'd say go easy a little bit on the regulators, you know. I have a story from way back. I went to, it was in South Africa, actually. I went to the Financial Markets Board there. I said, hey, you know, I'd like regulation for this product, Contract for Difference, we were launching. And the head of the wholesale markets looked at me and said, just because you create a new product, David, doesn't mean I have to regulate it. And to be fair, if you think about it, the market cap of crypto today is roughly $1 trillion, probably a bit less now. The market cap of gold is 10 trillion, maybe 12 trillion at current prices. So, you know, give them time. Regulation will always lag business, and that's not actually their fault, because it has to be there for 10 years, right? The framework, should they choose to use them? And I think worldwide we're getting there, but the biggest thing, honestly, is AML compliance, and I can't answer that too strongly. That will just make the world, the capital markets, DeFi or not, a better place.
Awesome. Yeah, very much agree. Regulation I see as definitely being good for the space as well. Guys, the next question is about kind of Bitcoin as a macro instrument, and I'm actually going to frame this slightly differently to each of you, actually, because you guys kind of operate different businesses. So David, I'll pick on you first. So I'm trying to understand the connection between events that happen in more kind of macro, larger capital markets and Bitcoin. So as the operator of an exchange and also like of a digital asset exchange, but also FX markets, how do you see the connection, or how do you think about the connection between Bitcoin and other larger kind of macro assets? Could be anything like correlation in volumes, like just what's your perspective on kind of how Bitcoin is seen as a macro asset, I guess?
It's very interesting. I'll probably will pass next on to a more investment rather than me. But what I see through all these cycles, just yesterday after FOMC, it's very interesting, right? So huge dollar strength, right? Indices off, risk assets off, gold off. And guess what? Bitcoin off, but actually not off as much as gold. Gold, I think, moved 7 or 8%. Bitcoin's moved what, 3-4%? So it's definitely correlated in some way, and becoming more correlated. It used to be completely uncorrelated. It's definitely correlated in some way. But so you're seeing that natural move, but not as much. It's not as perfectly correlated as, say, the S&P to the dollar, or yes, you know, euro dollar to any equity market. So, but there's definitely some correlation creeping in. And then the flip side of that, because you hear about all this QE that's going on, 45% of the world's dollars printed in the last 3 years or whatever. So on the other hand, people are looking at it as a store of value. So when ultimately you expect the cycle to continue, so when you have risk off, you'd expect people to go back into this safe haven, right? Digital gold, people call it. Look, I'm not an investment advisor. I'm fortunate. I haven't got to be evangelist for dollars, euros, gold, or even Bitcoin. I just have to match the buyers and sellers. But definitely you're seeing greater activity when there's movement in traditional capital markets have been pretty flat actually for the past 2 or 3 months. Certainly the currency markets have been pretty low vol and provided the vol, but you see in the correlation just in this past week.
Michael, do you have thoughts on that?
I mean, I think that, this kind of narrative around inflation and being an inflation hedge is certainly one that I think is taking, very good shape. I think what we've really seen is an intense focus on scarcity value and what that may mean. So I think for a lot of investors, the idea that they can own something that's verifiably scarce has very meaningful impact on kind of their conviction, not only in the value that inherently the asset may have, but it really kind of shows how sharply it contrasts with that of fiat currencies, which kind of continue to be printed. And so the last, 15, 16 months has really demonstrated that quite meaningfully. And I think that is, one of the most probably prevalent or winning attributes about Bitcoin that is resonating with investors today.
Yeah, awesome. Well, thanks, guys. We're in the last couple of minutes here. I guess I just want to give both of you the chance to kind of offer any closing thoughts, and also just if folks are interested in finding out more about your businesses or following you or whatever it is, like what's the best way to do that? David, I'll pick on you to go first here.
You don't never picking on me when I'm talking about me and LMAX Group. So it's pretty easy, .com, lmaxdigital.com, you'll find all about us. First name, last name at lmax.com. But look, I think overall, we're very bullish about the future. We hope that we can really add something to the overall ecosystem. We're passionate about capital markets. We're passionate about transparency and the purity of technology within capital markets. So genuinely, it's not just about turning a buck. We actually want to help this ecosystem. I think the crypto ecosystem is part of the future, a big part of the future of capital markets. If you're not trading it today, if you're not invested today, I think you kind of do what I do a little bit in DeFi. The best way to learn is to start, right? Okay, not with huge amounts of your net worth or your assets under management, but just start to learn, because certainly our kids and our grandchildren will be interacting with this as normally as you interact with the internet. That's just the fact.
Great.
David's advice on if you're not involved, get involved in a small way. Getting involved in a small way really helps people to pay attention. But I also think as much as action and kind of learning through action is really important, education is even more important. So come visit us at grayscale.com. Huge library of resources, white papers, primers on single digital assets, portfolio construction, valuation, you name it. Love to be a resource. Would hope we can be helpful to people as they're navigating crypto.
Awesome. Well, thank you guys so much for a really interesting conversation. I really appreciate the time. I know everyone on the chat found it helpful as well. Again, a big shout out and thank you to David and the folks at LMAX for making this entire conversation possible. I mean, you heard a lot about their business today, but if you're an institution, a professional trader, I highly recommend you go check out. The product is great. I get their volume reports. It is really popping off. So that I can tell business is great. Customers are happy. I highly recommend you go check them out. And for folks who are still on the line who are interested in this conversation, our next webinar is coming up on the 22nd. We're going to be talking about the rapid growth of crypto options and structured products. So definitely tune in for that as well. David and Michael, this was a ton of fun. Thank you guys so much for doing this. We'll see you next time.
Thank you.
Thank you both.